Hello and good day. Bill Kenny here with Meet, and it is a pleasure to have you for today's topic, which is benchmarks, goals, metrics, and ROI. Everything you need to know about measuring trade show results. This is a huge frustration for many of you in our audience, and we're here today to help you develop the systems so that you know not only how you're doing at your events, but how you can quickly evolve your success and also to be able to continue to choose better and better events and also maybe even negotiate a little bit better based on what you learn. So for those that haven't been on our webinars before, and today we have people from all over the world. We have people who not only B2B companies who are exhibiting at trade fairs and trade shows and in-person events. We also have economic development and trade organizations who are hosting pavilions, and so this is a pretty broad audience that's interested in this topic. So if you haven't been on our webinars before, I'm going to hop off screen and put up some slides. We'll have some content. Hopefully you'll find this to be really effective for you. And then I'll hop back on screen and answer the questions that you pre-submitted and certainly any others that you want to submit. And if you're watching this as a recording, feel free to add additional questions in the YouTube comments or certainly email us, and we're happy to address any additional questions. So without further ado, let's hop into it. I'm going to pop on the screen share here and share my screen with you. So you should now see my slides, and I'm going to just make that box a little smaller. Okay, so the ubiquitous title slide, let's hop into our content. So you probably have seen this quote somewhere before. It says that 50% of marketing dollars are wasted. We just don't know which 50%. And you can imagine a marketing executive reporting this to the CEO at some point, and it's very normal. And trade shows, trade fairs, and in-person events fall right into this category. Traditionally, they're hard to measure, and today we're going to overcome that obstacle and help you measure them and also get much better at exhibiting. So you submitted many questions. We'll get to these at the end, but I at least wanted to let you know that we got them, and we'll definitely take care of addressing them. So our agenda is simple. We're going to set the table, define success, take a look at alternatives, and I would even say recommendations. We'll look at an event cookbook, which essentially will be a tool to measure ROI. We'll take a look at future value. So from this information, what do we do and what actions? How will it help us improve? And then again, your questions, and feel free to submit additional questions as we're going. So just so you know a little bit about me, and the intent here isn't to be marketing oriented, but just so you know the context of my comments. At trade shows, I have been both an exhibitor, I have hosted trade shows, and now advising and supporting companies who are going to trade shows, in doing this for 30 plus years, and we have a team that has similar experience, and our company specializes in helping international B2B companies enter and scale into the US. And we kind of have 4 different areas we focus on. The strategy, so kind of the things we're talking about today, and essentially helping with event selection and planning and ROI measurement. We'll also provide staff, we'll get the executive speaking opportunities, and we'll do all sorts of sales support, such as appointment setting and competitive intelligence and things like that. So that's the extent of the marketing. So if you have questions on that, please reach out. Certainly happy to help you. And if we're not the right resource, happy to refer you to someone who might be better. So in any event, so let's hop into the content. So setting the table, obviously this is kind of a massive topic, and again, one that many of us struggle with. So we want to make sure that there's context to where we're going to go. So the first question we get asked is, are there are trade shows still relevant? You know, they've been around forever. You know, we have the digital age. My gosh, can't we do all this electronically? And so when you look at B2B sales, really every other form of marketing that you use is aimed at creating appointments with an executive or with an economic or a buyer with budget or authority. And the kind of the cool thing about trade shows is that you're actually face to face with people. So you actually get to skip a few steps forward in building relationship, because it's not some sort of electronic bot that finds them. It's actually a person, and that interaction has significant value, and you can qualify and disqualify better in person. You can understand empathically people's points of view that, again, help you move not only this relationship forward, but also build the system of building relationships and converting or essentially acquiring good prospects and converting them to good customers. So that process gets easier because of the feedback and the interaction that we can have in person. So if we're going to be friends, and I so want us to be friends, is we need to agree on what a prospect is, because this is actually it seems like a fundamental issue, and it certainly is, but it's something we see companies struggle with all the time, and not just early stage, but very mature companies struggle, and we see everything from this sort of definition to prospect definition creep. In other words, the who we're targeting tends to expand. Some of us get scarcity mentality, and we don't want to deselect anyone, but we do that at our own peril, because when our marketing becomes less focused, when we're trying to speak to everyone, we end up speaking to no one, and we need to make sure that we really have a very tight definition of a prospect. So as we see it, there are three qualities that a prospect has, very simply. They have to have a need, they need to have money, and they need to be urgent. If they're not all three, they're not a prospect. If they have two out of the three, they're not a prospect. It's really, really critical that we not only believe this, but that we build our buyer personas and who we're targeting based on this criteria, because this will inform literally 100% of how we build our marketing strategy, and essentially our success will come from our ability to do this. The easiest way to remember this is just think need, money, now. So again, need to have a need, they need to have money, and they need to be urgent. So why measure? Ultimately, again, this is the day of adages. The next adage is, if you can't measure it, you can't manage it. Ultimately, we want to inform our decisions. That's our goal here. This is very much like the GPS in your car or on your boat or on the golf course. This is giving us waypoints, this is giving us direction, and it not only informs our decisions and helps us make better decisions, but it helps empower our team to know what good and better is. And there are lots of ways that we can use this information, not only to measure results afterwards, but actually to set targets beforehand. And we'll get into that as we look at our trade show cookbook, which will be a very powerful tool for you. So we're going to measure things both absolutely and then comparatively. Certainly, the first measurements we do will be absolute, because we'll have no relative measures to do any comparisons. So they'll be very abstract. In other words, we're measuring this event and essentially evaluating it abstractly. But as we get some history, we'll be able to do some comparative measures, both against that same event in a different period or in the future, and also event to event, and being able to look at how we're progressing with like audiences or dissimilar audiences even. And so there are a lot of sort of ways that we can use this information. So return on investment is really a very simple formula. It's simply gains minus costs, which is essentially the change, right? The delta, what we got over what we spent, or minus what we spent, gives us the change or the gain, and then over the cost. So we have to know what we invested to get this return. And so really simple formula. And what we're going to find is that the costs are really fairly easy. And we're going to have both direct and indirect costs, and probably easier at first just to look at direct costs. In other words, these are things that we can talk to our accounting department about, and to be able to establish, the cost of the event, the cost of flights, the cost of hotels, and so on. And the real direct cost. The indirect costs or softer costs might be what we would spend for employees' time, and the variety of other types of soft costs, our marketing department and their investment in terms of building materials for the event. But again, the costs are really much more an accounting function and easy to establish. The gains, on the other hand, quite often are elusive because there are so many different things that we can look at in order to establish what the gains are. And we'll go through those, but ultimately, we're going to spend most of our time today talking about not just what gains we might want to look at, but also how we can measure them and begin to rationalize them so that they can give us good information. So defining success certainly is a challenge for a lot of us, and that's really the fundamental part of what we're going to talk about today. So let's take a look at how we might define success, because that's going to be the gains that we talk about. So what gains could we possibly look at? And quite often, the one gain that I see people measure all the time is how many cards did we collect? How many people did we meet? Certainly one way to measure it, probably not super productive, as we'll see in just a moment. We could also look at the quality of prospects identified. So we might look at a subset of those cards, and those that fit some criteria. We might look at revenue generated. Certainly, that's a bit of a challenge because in business-to-business sales, often our sales cycle might be anywhere from 6 months to 24 months, or maybe even longer. So having to wait that long to know how productive our event was is problematic for sure. Here's the one that we'll probably circle and really get to focus on, and where we've found is the key metric in all of this, and that is the number of prospect appointments set. And we usually look 15 to 30 days post-event, and we'll look at how many appointments resulted from this event. And those would be first appointment set is usually the criteria. So in other words, it's not, if it's somebody we already knew, we don't count that. This is essentially all new opportunities. But a number of appointments or prospect appointments set, or first appointments set with new prospects. Something like that is really where you want to aim. And again, 15 to 30 days after the event, you're going to know how your event produced. And as we'll see, this ends up being a really good indicator of sales closed. So cards collected, here's where the wheels start to come off of this one. So we've all seen at trade shows we go to the booths that are giving away an iPad or a television or some other device like this. We may have even done it. I'm guessing there are a few people on this webinar that have given away some tangible product that has nothing whatsoever to do with their business or in any way qualifies somebody as a prospect. And so this obviously is exceptionally dangerous if we're looking for prospects, because we're not at all going to find prospects. We're going to find people that, for whatever reason, want an iPad, which is really not an indicator of anything worthwhile for most of us. And so, other than collecting cards, and again, if our measurement is cards collected, this is probably a reasonable thing to do. Give away a round trip ticket to somewhere too. That it would just be just as valuable in terms of qualifying people, which of course it's not going to be. So when we think about prospects and qualifying people, this is probably the best metaphor that you'll find. And so, the people that really understand qualifying targets are fishermen or fisherwomen. And they do this, it's really interesting actually. Anybody that fishes, before they leave their house, there's one question that they can answer. And it's really the first question that they focus on, and that is, what do I want to catch? Once they've decided what they want to catch, that tells them where they're going to go fishing, it tells them what equipment they're going to take, and ultimately it tells them what bait they're going to put in the water. And so they need to know what they want to catch, and that tells them all of the other steps they need to do to acquire that customer or that fish. And so when you think about this, and the reason I throw up a graphic about freshwater fish in America is to really demonstrate how many fish there are. In fact, probably most people on the call don't know that there are 34,000 species of fish in the world, and there are lots of subspecies. So there may be 100 or 100,000+ different types of fish that somebody that fishes when they're leaving their front door might choose to target or look to catch. And again, that's going to change you as they choose different ones. It's going to change where they fish, what time of day they fish, what equipment they take, what bait they take, what bait they put in the water. Essentially, all of those types of things might change. But the real brilliance of somebody that fishes is not the selection of one fish, it's the deselection of 33,999 species. That's the much harder part of this, is to say, by choosing this, we're not choosing, in fact, we're not at all interested in choosing these other ones. And so making sure you understand that, and as you're defining what you want to catch, that it's really a very conscious effort to say, we don't want to catch these other things, which helps us much better tune the type of bait that we're going to use. So, we can measure certainly the quality of prospects identified, and in doing so, the quantity of high quality prospects can be certainly measured, and making sure that we catch what we're aiming for. We can look at cost per lead, so fairly simple. It's just a math problem, and again, we'll get that information from accounting in terms of our cost, and we'll know the number of leads we can collected. We can look at media traffic generated. That certainly could be social media, print media, electronic and TV media, all of that. We can look at revenue generated. Again, the biggest challenge of that is it's a long time to get that number. And by then, you'll have different salespeople. You'll have different, all different types of strategies and tactics. So it's really hard to say that that's going to be any value whatsoever. And again, where we're going to really focus here is taking a look at the number of prospect appointments set, because we can do that, and it's going to be something that we'll know in a very short time frame to be able to establish the value of this event. And again, this is going to be a very good leading indicator of sales closed. So our recommendation, and this is really, we're going to come down to one alternative here that we're going to look at, and there are shades of this alternative, but again, you can implement it in different, I think, in different levels of intensity, and it really depends on you know, all the different variables that you have, and we'll hop into that. So the marketing funnel, and we're going to talk both about a marketing funnel and about a sales funnel. They're very different animals. So the goal of marketing, when we look at B2B, you know, if we really distill it down, is to, at the beginning, find suspects, people that we think are prospects, and move them through some kind of a process, a nurturing process, to get them to a place where they agree to an appointment. And so this is our representation of what that looks like. We're going to go through 3 stages. We're going to go from awareness to intimacy to trust. And so, you know, the first stage, when they're a suspect, they have that sort of initial identification of us. We maybe meet at a trade show or an event, or they come to our website, they see an advertisement, they see us on social media. They get their initial awareness, and ideally we get some awareness of them. And then as we get to know them a little bit, we invite them to a webinar, they download one of our white papers, they begin getting more intimacy with us, and of course us with them. And ideally, as they go through that process, trust begins to evolve and some sense of credibility and competence. And so as they sort of get into that place of trust, then ideally they convert to agreeing to an appointment with the sales team. And as they go to that, then they're gonna essentially get into the sales funnel. And not to say that they're going to leave the marketing funnel, we'll still sort of nurture the relationship, but the primary responsibility for interaction prospects, and we've got other webinars on this in terms of our strategy in the booth and in the general attendee, and they're really very good ways to be able to do that, and we see very few people doing it. So you can separate yourself very quickly in terms of the return you create by changing up your strategy when you go to these events, because it's not very hard, but it does take some thought. So the next stage, certainly that we've held a first meeting, and again, that's ideally where we're going to start and be able to hand this off to the sales team, is actually at step 3 of 6. We're going to submit a proposal. Ideally, we sign a contract or create some kind of agreement, or they say yes. And then finally, we've received a first order. We don't like to take someone out of the funnel until we've received that first order. Even if we have a signed contract, that first order with a purchase order or whatnot is a much greater assurance that we've taken them all the way through, and then it's really a maintenance standpoint. And we may have implementation that happens. We still probably have some hand holding in order to make sure that the relationship sticks, and maybe you want to even measure through the second or the third order, whatever makes sense in your business. So before we get to the event cookbook, there are some numbers that we want to get that will help us with the event cookbook, and they're going to come from what we call the sales management cookbook. And this essentially helps us establish some baselines or some norms. And we're going to want this, we want to be able to know a variety of things, like the average value of a client. And this is really very simple to establish. You're just going to take your total revenue for a year, and you're going to divide it by the number of customers or clients that you build. Don't do it any other way. People try to think their way through this. It's not that difficult. Total revenue for a year, the most recent year, or the most recent 12 months, divided by the number of clients, customers, people that you build And so that would give you the average value of a customer. And that will be very helpful. There'll be a few other numbers that we're going to want to get. So, and I apologize up front, this will look complicated. I am more than happy to share this in our event cookbook with anybody. If just email me and we'll certainly share it with you. But the easiest way to do this, I'm just going to go to the live spreadsheet and we can scroll through this. So you're going to have, and I'm not going to go into the detail of this, but you've got a variety of inputs. Again, we're just going to look at the different sales stages. If we go down to row 10, then we're going to look at the number of suspects that we met. We'll look at the number of new prospects that we qualified, how many meetings were held, and this will be in a certain time period. In this case, the example is for the fourth quarter of 2019. So we met 200 people, 45 of them we estimate were qualified, 35 of them agreed to meetings and we held those, 10 of them we created proposals for, we got 5 signed contracts, and 3 first orders were received. So to think about that, if we call the first order is the acquisition of a new customer, it took 200 suspects to create 3 customers. So now we have a ratio. This isn't very hard at all. We have a ratio of so many different things. So we can look at this and say, okay, so we have ratio of number of suspects to going down to row 23 to first orders received. So we need 66.7 suspects to create a first order. We need 40 suspects to get a signed contract. And again, your ratios, your numbers are going to be different, but all you have to do is plug in your numbers from the yellow, and the green will be automatically calculated. You can also look at the number of prospects. So maybe you're starting a little bit further down and you feel the people that you're putting onto the pipeline are actually prospects. So it only takes 15 prospects to get a first order or a new customer. It only takes 9 prospects to get a signed contract. And from all this, we project the annual value of a new customer in the period that we measured, in this case, 2019, was $1.2 million. So that's the annual value of a new customer. So we can, if we landed 3 new customers, we know that's $3.6 million. And again, our numbers would be different. That's not really the point. The point is that once we input these, let's see, 8 items, then or 9 items, then we're going to get some really good ratios that we can then go and use to inform essentially our projection tool and our ROI tool, the trade show cookbook. That will help us really figure out what kind of return we're getting from these events. So let's go, without further ado, let's go to the exhibitor and trade show ROI cookbook. And again, I'm happy to share this with anybody. Just email me. It's bill@meetroi.com. And so again, I'm giving you a static picture here. Let's go over to the cookbook itself. And here it comes. So just like the other sheet, the yellow how many, I should mention that we separate out activities. You'll see here prospect revenue goal in the booth, parenthetically on row 7, and agreement signed revenue goal sales. So at trade shows, B2B trade shows, we separate out roles. There are the activities that go on in the booth, and they are the activities that go on outside the booth. In the booth, it's we look at a trade show booth for B2B companies. The only focus that we really have is essentially identifying the prospects that are in the event for this particular company. And so if it's an event with, whether it's 1,000 or 10,000 or 100,000 people, we want to find the, 0.5 or 0.2%, 50, 100, 200 prospects that are in the room. Again, they have to have a need, they need to have money, and they need to be urgent. So the booth is totally focused on that, both in terms of the message that we'll create. So we're not going to give multiple messages, ideally one message, and it's going to be aimed, it's going to be bait for that particular fish we're aiming at. Outside the booth are going to be where the salespeople are. They're going to be in one-on-one meetings with ideally people that are already prospects that are already in the sales funnel. Maybe they have a proposal, or we're at the later stages of signing the deal, or they're meeting with existing customers that we can get more business from, we can penetrate further, or maybe they're meeting with strategic partners. In either case, they're working on closing business. We're not going to close business generally in the booth because we know our sales cycle is longer than that. We need to get to the point of trust. We need to have direct meetings, one-on-one type meetings, in order to both qualify, propose, and close on that business. And that's generally not going to happen in the booth. We can always skip people forward if they come to the booth and they're more accelerated to have a one-on-one meeting with the salespeople. But the normal people we're interacting with at the booth, we're really just trying to identify the prospects of all of the suspects or all of the attendees. We want to separate out the vast minority, or the minority who are actually prospects. So we're going to have different goals for each activity. We want to, and again, this is an example. So we're saying in this example that in the booth, we want to identify at least $150,000 of new business. And in the sales activity in row 8 here, we want to close at least $200,000 of business. These numbers are very arbitrary. I just threw them in here to put some numbers in. And then the partners we want to meet, and you might not have a partner goal at every event or even any event, but in this case, we want to identify 6 partners, and we want to shop 12 competitors. So other things that we're going to put in here are some parameters around the event. How many days is the event? What's the length of the day for each staff member? How many booth staff will there be? In this case, 3. And then what's our average revenue per customer? Again, looking at either the last 12 months or the last year, but what's our average revenue? In this case, different than the previous example, it's only $25,000 versus 1.2 million. And then the number of sales reps we have attending, because that will tell us who's available to do appointments. We have 2. And then we're just taking some ratios that we know about our business. How many prospects do we need to have in order to get an appointment? How many prospect first appointments to get a proposal? And then how many proposals to close? And it will be the same ratio with partners. And if there's anyone doing some competitive intelligence, we'd put in how many there are there. And so then we're going to look at these different sections. So here's our exhibit goal, and the system has calculated our targets. And we can actually break this down by staff member. Once we know that we need, in order to hit our goal of $150,000 in new prospects identified, then we're going to oops, I'm sorry, I went too far. We're going to be able to easily know that means we need to generate 240 new contacts, and that we can boil down by staff member. Maybe we have a lead staff member, we're going to give them a little bit more. a little bit more of the burden of this budget. And you always want to budget over what your target is. At least that's what we do. And that way, if there's anyone gets sick or there's a kerfuffle of any kind, you make sure that your goal isn't sacrificed. But we can actually then boil down to the number of contacts each person needs per day, the number of contacts per hour, the number of contacts per hour per person. So it's really not heavy lifting. 4 new contacts or prospects, qualified prospects per person per hour. It's just 1 every 15 minutes. That's not a big burden. And again, your numbers are going to be different, but it's amazing when you have this goal in the booth, how then you can build incentives for the booth staff and even giving them something to compete against, something to achieve. The part of the challenge of all of this is the results are so intangible, it's hard to get people to focus on accomplishing something. They just have conversations as opposed to purposeful conversations that are essentially aimed at specific goals. So you'll get better at this as you use this tool or a tool like it. But again, if you can inform your team what their specific goals are, you're going to be much more likely to be effective at doing that. You can do the same thing with the sales rep. So if our target is $200,000 in closed business, then what is that? It's going to be 3.3 appointments per rep per day, according to line 40. And we might have a disproportionate budget for each rep. Maybe rep 1 is much more experienced and rep 2 is newer, or rep 2 is only going to be there one day, or whatever the case might be. But again, you can build your targets by rep. And so it's really important to be able to do that. And you can equate the cost per revenue created. And this is going to be overstating it because this is only looking at the cost, just 100% of the cost against only part of the overall goal of the event. So that does need to be somewhat adjusted for that because obviously you have more goals at the event than just closing the $200,000. You're doing other things like meeting partners or getting qualified leads. And so again, you can look at partners, you can look at competitive intelligence or competitor intelligence, and in each case, give who's ever performing that activity specific goals, and then you can measure against those goals. So here's your goal, here's your results, here's how you performed, and you can do that on an hourly, a daily, an event by event basis. And again, you can then make that your metric for how do you choose who gets the privilege of going to future events. Because sometimes in many organizations, going to events is looked at as something that's a reward. We're a meritocracy, man. This is not a reward. You have to earn the right to go to these events, and that's going to be based on your performance. So that's going to be a real key feature. Again, we're kind of hitting a lot all in one shot. Please reach out if you would like to go through or to be emailed these. I'd be more than happy to email these cookbooks to you and or have a call and walk through them in more detail for your specific purpose. All right, so it's great to have this information, but what's the future value of it? How do we use this information to really make our event decisions better, to improve our performance at events, and so on? One is certainly empowering your people pre-event in terms of giving them goals. Besides that would be to be able to do event-to-event comparisons. So not only can you look at the 8 events that you've done in the last year and be able to relatively evaluate their value for you. And there may be reasons why some have performed better and some have worse, and you have to overlay that dimension onto it. But one of the really cool things that you can do besides your own assessment and how you would improve your performance is you can actually take this, for example, to the bottom 4, and I very regularly do this for our clients, is I will go and as we look at every every quarter at our events, I'll go in and talk to the people who are on the bottom half of the performance, that are different event hosts that are in the bottom half of our performance ranking, and talk to them as a partner about how do we improve the performance at their event. You know, the goal is that we think your audience is the right audience for us, right? It's the right fish, it's the right body of water, it's the right pool. But for whatever reason, your event is not producing the results that compete with the better producing events. So how do we change that? And we know from the ROI formula that there are only two variables, right? It's cost and essentially value. So what is it costing us, and what are the gains that we're creating? And so we either have to get better at creating gains, or we have to reduce the cost, or maybe a combination of those two. Maybe we need a better position, or maybe there's a variety of pre-event and post-event values that the host can give us, or maybe they reduce the cost. But ultimately, we need to be thoughtful about how we do this. And I can tell you, as an event host, I never had anyone come to me with this. And I know that when we go and talk to event hosts with this kind of information, they are so open to working with us, because here they finally have someone that's approaching event participation analytically as opposed to emotionally. And most people approach this emotionally. It's either we've always done this or these events before, and so that's our comfort zone, or that's where we feel we should be, or I'm just tired of going to Las Vegas, so we're gonna switch it up. Any of those kinds of things. But you want to look at this analytically, and ultimately you can. It's really not that hard. So you can also look at it as year-to-year comparisons at the same event. So in this case, we're evaluating the same event between 2015 and 2018, and looking how we're progressing our results. And there may be very good reasons for the higher and lower performance beyond what is simple, but you're going to overlay that. I think over time, the numbers bear out, and some things have improved in order for us to get better results progressively, for the most part, year to year. And so we just want to make sure that we're aligned with what we're doing, and continuing to improve on that, so that we're optimizing the results we get at these events. So why do we measure? We come right back to it. We want to inform our decisions. We want to be able to manage what we're doing better. And ultimately, we want to know which 50% of our marketing dollars are being wasted, and reduce that number. Make it so that more and more of our marketing dollars are well spent. And so hopefully this was really helpful to you. You'll see the questions that you pre-submitted on the screen. Which I certainly would invite you to email me or call anytime. So I'm going to stop the screen sharing and come back on screen for you. Hello, how are you? And we'll go through your questions. And there's some really good ones submitted here, so I want to make sure that we give them the proper due here. So I would say the first thing to do is to start measuring, and your ability to evaluate your conferences is going to be much better. So when we work with market entry clients, we don't typically in the first 6 months do anything that is a big investment. In fact, it's all local and regional events, because we want to solidify both the sales process and answer some of the questions that we talked about, like having some assurance that we're aiming at the right fish, making sure that our value proposition is strong and that we're going to the right places, and that our call to action or our bait is compelling. And usually in that first 6 months, we'll do 100 or hundreds of tests to confirm and validate our processes. And at the same time, as we get traction and begin to land new customers, we're also validating the operational process. Can we deliver on our promise? And we want to make sure that we get those things in place, because you want to use that first 6 months as sort of maybe a soft launch, but a gentle ramp, so that once you've got all those ducks in a line, then you can put the rocket fuel on and scale. But if you don't have attention to that, then you might have a lot of false starts and actually turn over people, turn over customers, turn over team members, and so on, which is really dangerous as well. So there are a lot of reasons behind, that philosophy of ours, and happy to talk to anyone in more detail about it. The next question is, how does the number of attendees affect the value of a conference? I think by itself, it should, assuming similar quantity or quality of people in attendance, and that's not being diminished by quantity, then certainly quantity having more is generally better, because it gives us a bigger pool from which to pull qualified prospects. So, but it's not a perfect answer. Again, you're asking this with probably some context, but as long as it's not overwhelmingly diluting the quality of the prospects, then I would say more is generally better, but not in the first 6 months. Smaller is better in the first 6 months. We got to do a lot of testing. How do you measure the quality of the conference? Of conference attendees? So yeah, we actually have, and in fact, our previous webinar was actually about planning, building your plan for 2020, and we shared a workbook to be able to do that. But there are a few criteria that you're going to want to look at, and it really starts with knowing who you're targeting, having a real clear buyer persona, and how well does this event, the participants at this event, maybe there's a ratio or percentage that you can look at that helps you create a quality score for that particular event, so that you can evaluate it versus all of the other potential events. And again, it's not difficult. It's just about having a system for that. So if you look up our webinars on YouTube, easy to find, or send me an email and I'll send you that. But very easy to measure the quality of conference attendees. And again, you want to do that with respect to probably a few other criteria. And again, they're all in that webinar. Do you consider or have a way to factor in upstream or downstream implications on events? Example, if event hosted a poor job of promoting the event this year and there was low attendance, or a new sales system disrupted follow-up on leads in a timely fashion, we might give some weight or credence to that, but ultimately, I'd suggest that the event host, if they messed up, they're probably going to mess up again. And if we did implement a new sales system, ideally we haven't lost how to do it manually, and we could work around that. But let's just imagine there was some act of God that we actually saw as a blip. Then, yeah, certainly we would give that weight or less weight to the results of this particular event this year or this month or this quarter, and sort of give it a pass on this particular occasion, but with full expectation of better performance as we go forward. So perhaps spending too much time trying to define a bunch of arbitrary metrics. Yeah, no, that you can measure indefinitely, and in a lot of cases you can measure things that aren't valuable, like trying to measure and waiting to see what closes, which again, it's going to really lag. It's going to be a lagging result, and very challenging to measure long term. And to give you results in a timely way. So yeah, there can be analysis paralysis, and you certainly have to avoid that. So anything you can do to sort of lighten the process, and we would tend to really prescribe simpler systems. And today I shared with you probably more complex, but generally not any of our clients use the full process. But if we don't have the full process, we can't break down the modules to apply them to specific use cases. But the simpler it is, the easier it's going to be for everybody to do, and the more likely it is that we're going to be consistent, not just in doing it, but how we do it, which ultimately is really important, because it's not just those abstract measures that are important. It's going to be being able to have the relative sense of performance, either year over year or period over period, or the performance against like events. So let's see. How to correlate the amount of the spend versus the return on the spend. What's the ratio? So there is no ideal ratio. This is situational, and so it's going to be very much dependent on the client, the industry, their goals at the event. And so it needs to be very much personalized to each use case. How to measure the value of people passing by the booth at a venue. That's really actually the goal. Is you want more people to pass the booth than stop. Just think of the fish underwater. If you have the right bait, many more fish swim by the bait than nibble on it. And ideally, the fish that nibble on the bait are the ones that you're intending to catch. And those, in our case, would have a need, they'd have money, and they would be urgent. So I would place a lot of value on people passing the booth, in that it is ideally creating a situation where the people that stop are much higher value and much more likely to close. I'm not sure that I would measure it. I would measure the people we set appointments with, for sure, but that certainly would give us some indication of the volume of people that passed. Okay, so the amount of people who are not doing it, yeah, almost no one successfully measures ROI at events. So that's why this information hopefully is both valuable for you and something that you see as at least a part of it where you can implement and begin getting some good metrics about what you're doing. There are so many trade shows. Would appreciate some tips on how to determine which make the most sense. Again, I'm going to recommend our last webinar, which was all about creating your trade show plan. So it was about building that strategy and evaluating which events to do, and we give tons of great information there. If you have any questions about how to find that webinar, please just email me. And then welcome tips how on a modest budget EDOs can maximize trade show attendance and booth. So yeah, that last webinar is perfect for this, and sort of how do you evaluate. But look at, there are lots of events that you can participate in that are much lower cost, but ultimately the first thing starts with really well defining who you want to catch, who you want to connect with and attract, and then it's really about looking at the array of events where those buyer personas are, and then utilizing those events in a way that you can identify and engage and enroll those prospects. And then the last question here are tips, tricks, and common things to do prep and connect with others post-trade show and follow-up. So yeah, no, there are tons of great ways to do follow-up, and ultimately you want to have a really strong nurturing system that gets people, we go back to that marketing funnel, that gets people, number one, that we identify those prospects, or we may start as suspects, but then our marketing funnel acts in a way that our prospects continue through, because we're providing them with opportunities and content and information that only they're interested in, and then they continue down to a place where, again, we have enough trust where they agree to an appointment, and then it becomes sort of a more sales-driven process from there forward. So hopefully this has answered many of your questions around creating good measures and in a way that allow you to sustain ROI measurement and also to inform much better decision making and help, whether it's help you negotiate better, help you empower your team to perform better at events. All of these are sort of key features of being able to use this process well. I'm going to invite you to please email me with any additional questions. We'd be happy to talk with anyone one-on-one and really go through your situation. It's really would be our pleasure to do so. And again, no obligation. And if it simply ends with us saying, good luck or connecting you to another resource, we'd be very happy to do that. So my email again is bill@meet, MEET, ROI, as in return on investment.com. bill@meetroi.com. So thank you. We hope you have a great rest of your day. It's 2020, and we really hope you have a super productive year and are able to kick butt and create unparalleled results to really break your budget and really just have a great year. So that's enough. I hope this has been productive, and we'll talk to you again hopefully sometime soon. Bye for now.